Hi. Let's learn about bond yield, what it is, why it matters, and how it's calculated. A bond yield is the return an investor realizes on a bond, which is essentially the return on the capital invested by an investor. Bond yields are different from bond prices, and both share an inverse relationship. The yield matches the bond's coupon rate when the bond is issued, and can be derived in different ways, including the coupon yield and current yield. The simplest way to calculate a bond yield is to divide its coupon payment by the face value of the bond. If a bond has a face value of $1,000 and makes interest or coupon payments of $100 per year, then its coupon rate is 10% or $100 divided by $1,000. Bonds are essentially a loan to bond issuers and are considered safe investments. They offer investors a reliable stream of income and provide bondholders with a fixed form of income. Bonds are rated by services approved by the Securities and Exchange Commission, and ratings range from AAA, as investment grade with the lowest risk, to D, which are bonds in default, or junk bonds, with the highest risk. Price and yield are inversely related. This means that as the price of a bond goes up, its yield goes down. Conversely, as the yield goes up, the price of the bond goes down. If interest rates rise, the bond's price will fall if the investor decides to sell it. If interest rates fall, the bond's price would rise because its coupon payment is more attractive. Additional calculations of a bond's yield include the YTM, bond equivalent yield, and effective annual yield, EAY. These calculations provide more precise annual yield given the coupon frequency and time value of money. Factors such as fractional periods and accrued interest skew the calculations in determining a bond's yield. Bonds can be quoted with a clean price that excludes the accrued interest, or a dirty price that includes the amount owed to reconcile the accrued interest. When bonds are quoted in a system like a Bloomberg or Reuters terminal, the clean price is used. A bond's yield is the return to an investor from the bond's interest, or coupon, payments. Higher yields mean that bond investors are owed larger interest payments, but may also be a sign of greater risk. Higher yields are often common with a longer maturity bond. Bond investment depends on an investor's circumstances, goals, and risk tolerance. Low-yield bonds may be better for investors who want a virtually risk-free asset, while high-yield bonds may be better suited for investors who are willing to accept a degree of risk in return for a higher return. Yields are used for more sophisticated analyses. Bonds of different maturities can be traded to take advantage of the yield curve, which plots the interest rates of bonds having equal credit quality but differing maturity dates. Here are 4 key takeaways. 1. Bond yield is the return an investor realizes on an investment in a bond. 2. A bond can be purchased for more than its face value, at a premium, or less than its face value, at a discount. 3. The current yield is the bond's coupon rate divided by its market price. 4. Price and yield are inversely related, and as the price of a bond goes up, its yield goes down. Hope this would help. Thanks for watching.